Okay, today is Friday, July 14th, 2017. And so it's Friday. So what do you know? We're not going to have a whole ton of trading on a Friday like today. Although there are some even keel economic reports, as in they matched previous economic reports in regard to economic vitality. And then what else? Oh, there were some positive economic reports. Okay, and let's go through these charts, see how they are working, and see if we can't set up for a few pieces of the pie before it's time to clock out. You know, they clock out early on Friday, so. Okay, so there's the NASDAQ. We're getting back up to a high here. Now this point right here looks kind of bearish to me. These right here look kind of bullish at first, right? So basically, how you read these charts, you consider recent wicks and tails and volume bars, but you consider the most recent the most, right? So basically this area, the bulls were biting pretty hard, but also remember this was a big step down right here, and not positive what that was for. 6-9. I could look it up and see what happened that day. 6-9, right? Yeah. So June 9th could just be the beginning of the earnings reports, quarterly earnings reports, and they could have just been taking profits there. I would have taken profits with this kind of. Look at this. This is all the tender spot right there. So. Okay, so these quick wicks right here, quick tails right here, very bullish there, but really it's just buying to cover and taking profits from this. That's just the reaction that you get. Although, now that's the reaction that you get when you gap, right? So this is a big gap. All right, so that big drop. So notice that it takes even more than that. Let's see here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, 10 days, all bullish days, right? All positive gains every single day to get that high, and then it falls down in one day. Okay, so when you fall or you jump that fast on these charts, it's called a gap. So you gap down, you gap up. And then there's something they call filling in the gap. So basically, after you make a huge chunk off the chart or put a big chunk on the chart, basically people have got to take profits. So when they start taking profits, people aren't interested in actually selling more necessarily. They would like to sell into some strength if they can, and that's what this was right here. So we had like they call it a fat cat bounce. Basically cat bounced, couldn't bounce all the way back up, and then they sell off into strength right there, and so basically if people have taken a lot of profits right here, they made a lot of profits and they're going to take profits, you don't necessarily want to keep on selling right there at the bottom. It can happen, but it's not as likely to happen. What's more likely to happen on a gap day is that you're going to get some buying to cover. the price is going to recover, the chart will recover, and then fill in approximately half of the gap at minimum, approximately, before the buyers give up, and then sellers are going to be looking for it. And that's the reason why they give up. They're going to see if the sellers are looking, right? It's kind of like if you're looking out around the corner, you don't really want to go until you know that they're not going to be shooting. So this is the corner halfway back up, right? And so we'll just watch. We'll stay behind the corner and see, are sellers going to start shooting, or are the institutions going to start picking this price up from here? And of course they start shooting. So luckily we did take our profits here from this move back up, which is a short squeeze. Now notice that this is a quick tail, right? It's actually two quick tails. Okay, so short squeeze right here, grab some profits. You got what, 2 days there, 3 days worth, so that was easy trading. And then you're halfway back up, now you're out. Now you're looking in either direction. And if you know how, if you're a savvy hedge pretzel kind of financial engineer of the charts and markets, then you could probably play this both ways, maybe in multiple markets or in the same market. Otherwise, you just hang tight and you see what's going to set up. You don't want to get involved in anything that you don't know what's going to happen, right? You just want to get involved in stuff that you know is going to happen, okay? Everything else is not for you. It may not be for you for your entire life. This may be stuff that you got to kind of like learn starting when you're younger, and then all the ideas will come to your head. Maybe if you just keep on working at this stuff, it might come to you in a decade, 5 years. It depends on how much you work on it. I mean, if you're working 2 jobs, or you're doing a lot of playing, you're playing with the money or whatever, you're involved in a lot of other stuff, then it's probably not for you. It'd be kind of like trying to do dog fights, right, with complex you got to have complex vision built into your memory. It's got to be working, and you got to be able to speak it and actually fit in the moment, the heat of the moment, as fast as possible, right? I mean, in the general idea of dogfight, I mean, a lot of these dogfights are basically just, the jets are so far apart that they never ever even see the other side before weapons are firing now. But let's say an 80s dogfight, Top Gun dogfight, okay? So you don't just play this thing maybe a little while, a couple of days out of the week, and maybe a couple of weeks out of the month, and then think you're going to be able to dance that kind of dance, right? You can't just walk into a Chinese pawn shop and start haggling deals with the brokers in China, and you've hardly ever spoken Chinese before, and then think you're going to get a real great deal. It's just not going to happen. You need to sound Chinese. You got to know the Chinese. What's the Chinese hits? What's the Chinese eeks? What eeks? And then try to get that person in the mood that he drops the price or gets the price up. It's whatever you're doing with them. So, and it's all in the moment. You've got one chance, and then that's it. So if you're not in rhythm, you got to be in rhythm with the tempo. You've got to know the macro scene. You've got to know the chart scene. You've got to know the team behind these charts. You've got to know the whole deal. You've got to know all the different strategies that you can do. You got to know from moment to moment what you got to do if this and this. You've got to have 3 answers for every situation that can come up. You know what I mean? And it's all got to stick. If you're not in the zone and you forget, I lost my place. Now, can you imagine if you were singing a song or you're playing a piano song and it's kind of complex and there's several levels, bridges, choruses, and then bodies. I guess that's what they call it, the different bodies of the thing. And then you actually forget which part of the thing you're in, right? And so now you don't know exactly how you're going to sell this gem. Okay, you're in the moment. You can't just call it off. It's live. This is live. Okay, so that is something to look forward to if you have a passion for this, and if you really want to make a lot of money. But in general, everybody else would just hang tight right here. And if you're just starting, you're going to hang tight. I mean, if you aren't even seeing it, okay, then you aren't knowing what to do. And so you hang tight and see what's going to happen here. So in this case, we got halfway back up. That's where you take a break here. And then it fell down. Now, this is the daily chart. This is not the 5-minute chart. Okay, so the thing fell back down. And now we've got a double bottom here. Touches that thing again and zip. Right, that's a quick tail. And so you get the short squeeze again. Okay, Viola, it's good trading. Once you see that double bottom right there, right, that quick tail and that double bottom, you can buy into this all the way back down to this double bottom here. Okay, so, and as you can see, let's see, I'll zoom it in for you. As you can see, this is a higher low. Okay, so because it didn't come all the way down again, right, and it left a pretty good size quick tail on that day, then that is fairly bullish. Okay, and therefore buying right here was a good idea. And then you would be holding on into this, and then you would be looking for the breakout here. Okay, any kind of breakout. Now, me personally, the way that I am, I'm looking for a breakout about this huge right here. That was it. Now this is actually more, right up to here, is actually more than I would be looking for. Normally, this is kind of no man's land right here. We've got a gap down for some reason, right? And then we've got the fat cat bounce here, which is not actual. It's not actual investing. It's just a mechanical reaction in the pricing mechanism. It's when short sellers have profited so much, okay, now they got to buy to cover in order to take those profits. You understand? And so when they do that, everybody sees it and they jump on the bandwagon. Now they really have to buy to cover in order to unload those shorts and take their profits. Before, they don't know, things could rise back up to the top up here and they lose all these profits, and they want to maximize profits. Okay, and so it's just a doggy pile, right? As soon as they see that there's buying to cover, it becomes a short squeeze, because everybody knows that they're buying to cover and everybody else is trying to buy along at the same time. It's just 2 times the actual buying, plus there are some long-term investors that might be buying as well. Okay, so it's 3 times the buying, and there's just not enough offers on the depth of market there to cover all of those buyers. And so price has to find supply, right, which is offers, but at higher prices. So let's say like you've got oh, I don't know, this is the NASDAQ. Okay, so let's say you've got 1 million NASDAQ contracts, okay, that are wanting to buy to cover, to buy to jump on the bear short squeeze, right, and to actually buy because they're actually investing long term. Okay, so this dome you can see on the left, right? So this thing is loaded with only some. Now this is actually the S&P on here, so this is what it looks like. So the offers here on the right only have so many contracts, right? And so we've, in total for the next couple of days, we've got 1 million contracts to fill. So what are we going to be doing? We're going to be knocking out, look, 16, 36, 28, 40, 40, 38, 76, you know, and it's going to be rotating up and down and so on and so forth. Okay, it's going to take a while to actually fill all of these orders that have to come through the exchange. Okay, and so where's price to go? This thing's only a feather, like, you know, little soft sparrow downy feather, right? It's just blowing in the wind here between the bids and offers and market orders, and it's just going to constantly blow up over because it keeps on knocking out all these offers and it just keeps on looking for more, right? So it winds back up, halfway back up the gap, and then you hang tight, right? And then, well, what do you know? Sellers come out, gone down the prices, comes back down, double bottom. Okay, obviously this is time to buy again. You got this because you've got the quick tail there, you've got the higher low right there, and you just hang on to this stuff on into a breakout, right? Because this is basically where your double top is at. Okay, and this is so bullish right here, right? Look at all these tails. Those are all bullish indicators. Also, the news is not saying, you know, we're in a flat spin goose, get me out of this cockpit, you know, the game's over. All right, so the news is not saying that. So basically you got to kind of figure that, okay, well, we got quick tails all over the place, we got higher lows here, this is going to break out. But then that's it. Once you're past the halfway point of this gap and you've already broken out, don't be looking for any more on this chart. Maybe on the 5-minute chart, yeah, for small plays. But if you're swing trading, okay, don't be looking for any more until you know better, unless you are an avid financial engineer of the skies, right? So you can fight whatever's coming at you. Whatever's coming at you, you've got 3 more options or more, right, to cut your costs down. You know, pay for your costs, shield against any oncoming costs, right? Constantly. It's a constant job. It's not something like baseball where you sit into a batter's box, you've got like 30 seconds, okay, and then 30 seconds, and then 30 seconds, and it's a total of 7 of those normally. Okay, this is constant. It should be all day if you're in that level, but that's a level you can strive for. Excuse me. And there's big rewards in it. I mean, it is Top Gun. Okay, you will be the richest person in your family ever in history. Okay, so here is our 5-minute chart, and yesterday was the last day of the FOMC meeting. You can see basically it's just a chop and drop day. Wound up being a little bit bullish, but basically neutral to me at the end of the day. Overnight here, the inventory is neutral all the way up until these economic reports hit the tape, and then it's long inventory. So basically there are more longs out there today as of the open, right here where the gray turns blue, and so you got to consider that. Basically that's the momentum of the crowd out there. You can basically base what's the team thinking, you know, what's the count on the symphony's song. You know, we're all basically in a symphony orchestra, you know, about where the team is at based on how they are reacting to the overnight inventory. So what is this? This is long inventory. Well, look, we don't even go any higher here, do we? Right? what are we doing? We're actually selling off. So nobody cares about that long inventory overnight. And what does that tell you? Well, it's a dud, right? Whatever that was a dud. These economic reports is a dud, at least for today. Okay. Could things change? They could change, but it's not likely. If you don't see things change within the next, let's see, this is 1 hour right here after the open of the equities market. Okay. And if you don't see things change right here within another hour, then basically long-term investors are out of it today. This is all just almost dead air. This is all algorithmic desert right here, okay? The computers basically run out here, right? It's kind of helter-skelter. So it's kind of fun if you know how to, if you know that they're always out to get you. So basically, if you can trick them, it's amusing. And that's how it is on Friday. I mean, that's kind of how it is every day, but normally it's algo desert after, 3 or 4 hours from the open of the equities market. Okay, but on Friday it can be just 1 or 2. Very rarely longer than that. Okay, and basically, in order to break this high right here from the overnight and keep this long inventory going, you're actually going to have those long-term investors come in here and hit their buy programs and push this whole world up, which is impossible for the day traders. Okay, even though there's a lot of size. Okay, but it's just, once we make some profits, we're going to get out and we're not pushing any further. So you've actually got to get the long-term investors to make this a mountain. You know what? This is S&P 500. You got to look at the daily chart on this one. This one actually matters more than the Nasdaq. Okay, and the reason why is because it is the bellwether of the world. The Nasdaq is not the bellwether of the world, although I speculate someday it may become so, because technology is its own leverage. So it could become more indicative of much more. Now you have to understand that on the S&P 500 you would see stuff like the mega grocers, right? But you would see only Amazon on the Nasdaq. You wouldn't see like a big Kroger or whatever on the Nasdaq, right? And there's a lot of companies like that, okay? Because Amazon is a tech company, that's what they categorize it, okay? Therefore, it gets on the Nasdaq. It's one of the leaders, okay? But Kroger is not, okay? So, but Amazon is also on the S&P 500 as well. All right, so we've got the huge quick tail right here. The thing, look, here's where the close was on this day. This was the June 29th on this test. And then here's the bottom of the quick tail. Right, this was support. We didn't quite reach it, but once we got down into this zone, every pike and bass was striking that line, and so they bought it all back up within the same day. So basically that gap down was all fixed up halfway back up in the same day. All right, and so with that much aggression in one day, okay, you kind of figure that it's a little bit bullish. So yeah, a lot of buying here, obviously, but a lot of short covering, okay, taking profits on that, trying to get whatever was made on that, and also, you know, reacting to this huge bite down here. Okay. But every time they were doing that, every time they were buying it up here, you've got the quick wicks here where they were just hitting these things again, over and over, just basically knocking it back down to barely moved on the day. Okay, until it starts trending down here. Okay, then they test lower again, right? So if you're saying, all right, this is really bullish here, and it gapped halfway back up, damn, they were hitting hard. Okay, but then you see 2 days of these quick wicks. I mean, this one, okay, yeah, I understand. The next day it happens again, after it was bought up this far, and then it gets knocked down again like this. Huh? Okay, so then, yeah, people aren't coming in to do this job again, right? So only halfway up this far again, and then the next day after they see that it was only halfway up, no, we're selling this thing. So you know, then we run all these stops down here. We've got longs down here, and they've got their stop orders right down here, and so just knock those over, goo up the market until they start striking again. But they didn't really hit that day, did they? No. But basically what you've got here, pay attention, and I'll explain the physics of this stuff. This probably sounds very routine or redundant. Yeah, I think redundant is the right word. Well, it's something that I notice when I listen to a lot of videos that basically if if somebody's just saying the exact same thing that you can see on these charts, you're not really learning anything. The only thing that you're learning is kind of what areas on these bars, areas on the charts that somebody is interested in, but you're not understanding why. And I think I've got to cover that. So as I was saying here, I'll get to it, but as I was saying here, you've got a higher low, right? Now that's significant. So you get this knocked down here, and then you've got a higher low. Okay, so that means something to me. I'm in tune with this market. You know what I mean? Like, to me, I hear a language, right? To you, if you're new, you're probably watching this. That's probably why you're watching this. And to you, this probably all seems like Sanskrit, like somebody's speaking Sanskrit from like 3,000 years ago or 5,000 years ago or whatever. Okay, so, but you want to learn it, right? Because you want to see what is going on with the team behind the chart, right? And that's really what it's all about, is what's going on with the team. So you know what not to do, and so you know where you're needed and what to do. Okay, and basically, when I'm looking at this thing, I'm actually seeing, where's the mood at? Where is the team taking things? Why is the team reacting this way? Okay, just like when you watch a game, perhaps on TV, or when you are listening to a conversation or maybe a talk show. And so that's where I've got to get you to, okay? And that's key to this. That is the key. And I didn't really realize that for a couple of years until finally it started snapping like that. And basically that kind of thing took me back to basically when I was kind of in the zone, when I used to be a tree climber, when I used to be a baseball player, and I realized that if I weren't in the zone, I had to wait and get myself back into it. It was a physical exercise in order to get myself backed up into that zone, so I can see what I'm not seeing, and it was so distinct, as if I was standing in daylight, and then I could just take a step back, and then I was in the dark. But it was kind of like in the dark, but I've got, maybe the virtual reality, maybe jet set over my eyes, right? And so I'm able to see all this data, in the language, and then I'm able to know why what is going on, and then I'm also able to know what can happen as a result of these things. As this thing plays out, what can't happen, that's important too. You gotta have the reciprocal of everything. What can't happen, for everything that can happen. And then you've got to be able to see what you can do, what you shouldn't do because you don't have enough data yet, and what you can do when you don't have enough data. And then every single thing that you do or don't do, you should have a couple of options in your mind working. Okay, what can I do now? What can I do now? And it's just this constant back and forth, bouncing off of the like a bat with the sonar voice, constantly bouncing off of everything that's happening in these charts, and then it comes back and you get a sense of where things are at, how things are evolving, where you got to be, kind of like a mission control tower watch for the airplanes, right? So basically helping the pilots position themselves in the air so that their vectors and their speeds are not lining up with each other and they don't hit each other, right? Different levels and kind of things. And as weird and complex as that sounds, that's basically it in a nutshell. Now that seems very complex. I guess maybe if you were used to driving an automatic car and then you got put into an 18-speed, big rig with a trailer on back, okay, and then you've got to be pulling across metros all day and night, and you've never had practice in these things yet. Yeah, it can seem kind of complex. All your vectors, all the braking, all the gearing. I mean, it's important. I mean, if you don't know, each of those gears is going to get you only so far, and the rest of the gears aren't going to get you there, right? So you got to know each of the 18 gears, how they talk to the road, right? And then how you've got to predict which ones you need in every moment, around the turns, around the cars, with different loads, different load weights, yada 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 yada. Okay, so, and it just happens, like when you're talking to somebody, it just happens, right? When you're walking, and then you're stepping over stuff, you're stepping around people, okay? You're going left, you're going right, you're going, the way you got to go to get to where you're going. It just happens, right? Eventually, this will just happen for you. Trading will just happen for you. Okay. It's just the way your brain works. It all comes into your vision. Brains learn languages, but really I think that brains learn sports, and I learn through experience that basically the two are the same thing. I know that in science, they don't regard the two as the same thing. They regard language learning and language execution as a sociological structure, and they regard sports as a motor skill. But I've learned that basically they're the same thing. And that language is useful for sociological purposes, right? Socializing. But so are sports. And so what's the difference? Right? Right. And so this is another language you got to learn. You first got to learn to see it, once you start to see it, then you can start to speak it, which is just executing the trades and constantly defending yourself. Knowing when you're pushing the envelope, how much more you can push the envelope, and then when to get out of it because it's no good, when to stay out of it, right? Just like socializing, and just like playing sports, just like driving as well. Okay, and so the rest of this is kind of self-explanatory. Basically, you've got this is a higher low, right? See all this space right here? All of these prices right here did not sell, right? So if you were a shopkeeper and you've got some products that aren't selling, what are you going to not buy? Right? I mean, if you're realizing that those things aren't moving, you're probably going to want to sell those at a reduced cost, right? To get most of your equity out of them so you can get out of those and get into whatever really is selling. So what's really selling? Well, these bully candies are, right? Bullies, not shorties. So you're going to invest in a bunch of bullies. Why? Because you want to sell them to whoever's buying these things up here at the highs, okay? And so that's what everybody else is doing. It's trending. That's the hot candy, right? And so you work that out. That is the business and the hedge savviness of the shopkeeper, just like a trader, just like in any kind of business, and technically in just life budgeting, all around, assuring yourself that you're not going over the edge, that you are being practical, right? Getting while the getting is good, keeping up with the opportunities, avoiding the risks, maximizing the gains over the long term. Okay, so obviously, another sell-off here. We checked it. Like I was saying before, you see this right here. You saw all this behavior. I would have shorted this, sold on down, and then these didn't sell. So obviously, shorties were not that hot. This was just a test lower. It failed. Okay. Bullies start selling off here, so this became a good opportunity to buy long, and then we get back up to here to this area and we test again. Now this was a shakeout right here. Okay, see the quick tail? All right, now that would have tricked me, right? I would have taken profits on this right here, because now we're getting back up to this area. I wouldn't be holding on necessarily. Maybe actually, you know what, I won't even say what I would do, but basically we're getting back up to this area, the top area, and I need more data. Basically what I would want is for the price to come up and then bounce off of support and then show me that it's going to rise again. Also, I am skeptical about the market overall, the whole system, right? And so I'm kind of leaning bearish. But then this thing sells off here. This would probably catch me off guard if I was staying in it to ride all the way up to here. So they shake it out again, but it only turns out to be another higher low and a huge quick tail, right? Look at that. Now that is really bullish. So you've got higher low, okay? A lot of quick tails here, okay? Despite these quick wicks up here saying, you know what, kind of bearish here. Plus this, kind of bearish. Finally, everybody's convinced, so it breaks out. After, if I came in and I saw this going on like this, or I stayed and I checked the charts at the end of the day, I would say, okay, I'm going to buy that. Okay, I'd either buy that evening or I'd buy the next morning if I were a swing trader. Okay. Now the thing is, though, is let me tell you what a swing trader is first. The swing trader is a medium trader. You got long-term investors that are in it for 6 months, multiple years. Then you've got swing traders that are in it for days and maybe weeks, and that's it. I think that some swing traders, their max is probably 3 months. Okay, 2 or 3 months. But most of their trading is days and weeks. And so all they're doing is they're just reading these, the day chart like we read the 5-minute chart. Okay, and they're dealing with bigger accounts, so therefore they need to trade a swing trade strategy, because if they're trading a day trade strategy, what's going to happen is they're trying to trade so much size that they're going to get really bad prices in a day trading scenario. Also, their accounts are so big that they need to diversify into multiple markets, so multiple stocks, multiple futures, multiple options, volatility vehicles like the VIX or the VXX, currencies, bonds, etc., etc. Maybe even in markets outside of Wall Street. Okay, so basically, if they diversify and then they hedge up with that whole portfolio, right? They're diversified, they're hedged up, and basically it's kind of like I put it like this: it's like farming, being an ag corporation, and you've got farms all around the world, right? So basically you've got different seasons and different different soil types, different climates, different et cetera in the area, and therefore you've got different crops, and you've got different rates of growth, and you've got different seasons of harvesting and planting. So on some parts of the world you could be planting, whereas on other parts of the world you could be harvesting, and then in other parts of the world in between. Okay, and so constantly, as the company management, basically what you're trying to do is you're trying to harvest, capitalize, cash in, and then funnel the money over to the preparation and the seeding, the watering and so forth, and then just constantly rotating, right? You're just constantly rotating the funds from field to field to field all around the world. Okay, and so with a diversified portfolio, it's the same thing, where if you're in some markets, basically they're going to come to fruition and profit at a certain time depending on what's ahead. Okay, whereas others may not come to fruition until after that, and there's no way they could come into fruition until after that, because you're in this opposite or inverse investment vehicle as a hedge somehow against the initial position that already came and profited and then passed by. The opportunity passed by. So one may be down, the other may be up. Grab profits in the one that's up, take the profits, invest in the one that's down, right? As long as there's sound investments, as in the company is sound, the country is sound, it's the industry is sound, etc., etc., etc. Okay, then if something comes down on you and you were invested and then you took a little loss for a little while, then you're probably going to add more to that, because it's not a bad investment. The price is just down, which is a sale for you, or you just wait it out and then wait for it to make back up the price loss and then some. So that's also another option. But basically it's just a teeter-totter, but with multiple teeter-totters. and constantly you should be profiting in some investments, and then constantly balancing those profits into investments that have pulled back and you've got prices down. Okay, and the reason why you would do that is because if you've got lower prices, first of all, that's a better deal because the things are cheaper, right? So if you're buying these things wholesale, okay, then you can invest in even more at a better price if you buy more. Kind of like buying bulk. You're going to average in at a lower price if you buy more. So you buy more. Also, you don't have to wait for the price to come back nearly as far to make as much as an investment that you just initially invested in and then you profited in right away. You didn't see a decrease in price. You just saw a profit right away. And so it doesn't give you an opportunity to invest in bulk at a lower price, right? And about those portfolios and investing like that and long-term investments and swing trades, basically you generally trade around a core or core trading. And what I mean by core is a core as in the center of something. Okay, so what you'll do is you'll allot so much of your cash in your portfolio. Now remember, cash is a position as well, right? Sometimes the market is doing things that you don't know what it's going to do, and then because your capital is in cash, right, you're actually profiting because you didn't really know what things were going to do. They wind up doing exactly what you wouldn't have done, and therefore you would have lost there. But because you were in cash, think of cash as just like another stock or just like another futures market. Okay, currency markets are just other markets. Same thing as real estate. So you could have several land slips in your portfolio, or you can have the basically the accounts that state that you have this much in currencies at your brokerages, okay, or your banks, etc., 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 right? So they're just legal contracts to verify that you are this wealthy. Okay. And so basically what you'll do is you'll allot so much capital to any investment. You'll say, all right, I don't want to put more than $1,000 on this, or $100,000 on this, or whatever. And then what you'll do is you'll divide it up into 4. Okay, so you'll always start out at 25%. Now, if you think that it just rose up too high, too fast already, then you don't start out at 25%. You wait for it to come down, right? Because why? Because people are taking profits and they're doing the exact same thing. So it'll come back down, and then you'll wait for it to, show that it's going to bounce. Once it starts to bounce, that's when you want to drop in. Okay, 25%. Now, the thing could continue to go down. You don't know. If it goes down even more, add another 25%. If it goes down even more, and you have done the work, and you know that this company is good, or the macroeconomic scene is good, the politics are good, the industry is good, etc., etc., then go ahead and stay in it and double down, which means that you've got 25% up high, 25% in the middle, down lower, and then at the bottom, at the lowest point, you've got 50%. So you double up down there. Okay. So where do you have to get out of that 100? Now that's 100% of your total capital that you allot to that one investment. So where do you average out at break even on that? I would say let's see. Well, if you've got two, this has stumped me. If you've got 50%, which is 2/4 of your total investment that you'll allot to that, okay, and the other two have lost, then probably, yeah, okay, so just below the second installment, okay, is where you'll break even. Somewhere around that second installment. I better say that I don't have an accurate, actual accurate place there, but basically the two quarters in this at the same time at the very low, okay, that should recover the other two that are spread apart up higher, somewhere around that middle investment, the second one. Okay, the second quarter, when it dropped down, you put in another quarter that second time. Okay, and then basically what you'll do is once you break even, you could hold on. I don't recommend holding on. I recommend being more conservative and at least take half of that position off once you break even. Now remember, you're averaged in low. You're not averaged in at the first 25% entry. Okay, at that price, you're not averaged in there. You're averaged in more around that second entry. So once you buy that last piece and it comes back up to that second entry, dump at least 2/4 off of that thing, so you're only 50% in. Okay, and if perhaps you invested a quarter and then it dropped, and then you invest another quarter and then it comes back up, okay, once you get back up to break even, I suggest dumping 25% of it. Okay, but it depends on the situation. If the situation is really bullish, go ahead and hang on for a breakout, you know. But normally the first thing that you want to do in a situation where you can get shot up is do what? Shoot or duck and get behind something. You probably want to duck and get behind something and then figure out if you can do anything right. Right? See if you can do anything right first, which is basically, right, get protected. Okay, because what's going to happen is a lot of times you'll find out the hard way is that price will come back up to break evens or thereabouts, and then it'll drop again, and you're already fully positioned. So the first thing that you want to do is once you start breaking even, start chucking some of that out into cash. So that way, if price does come in any lower, then basically what you want to do is put in whatever cash you've got on the side for that thing so you can buy lower prices, right? And that's the thing about cash, is you always want to have plenty of cash for any opportunities like that. So out of all your portfolio, no matter whether it's Wall Street markets or external markets out there like real estate or private businesses, etc., you never want to put all of your capital fully invested. I believe they say that 25% cash is always the best strategy. And I think that sounds pretty sound to me. 5 to 10% precious metals is also a sound strategy, which is there in case the system collapses. Now you've got central banks. You know, they are not right and they are not sound. Okay, those are ran by megalomaniacs. Okay, so they've got a horrible history. Now, if you don't believe me, That means you haven't done the homework yet. You've got an internet. You can cover that stuff within a year or two, but it's one of the best investments you can do, because if you don't do it, then you're never going to believe that you're at risk. And then perhaps you don't insure yourself, and therefore, if we ever get hit, you're knocked completely out of the game, whereas where other people were, conservatives, preppers, that kind of thing, they were completely insured, so they aren't even knocked out of the game and they're still going, right? And you've got people depending on you and that kind of thing, so people without money are voiceless people. And I believe that, I think that the protocol for positions in the from the portfolio is something like 1% to 5%, but never any more than 5% of your portfolio in any one position. But I kind of think of things like this. It depends, right? It depends on how you're doing it. Now, for day trading, okay, like 0.01% of the time you might be fully invested. So if you're day trading for the firm, maybe, yeah, and you can be. It's allowable. They do it. Every once in a while, I'll be fully invested. Once in a blue moon, okay. But the situation has to be so sure, okay, that there's no mistaking here. Otherwise, the way I always explain it, it's like trying to fit through a tunnel through a mountain with too much of a load stacked up on the back. And so when I drive through that tunnel, I get the whole top knocked off, and then I'm set back, right? And it's just like that, right? I've only got so much of a drawdown on the account, right? I can only be drawn down so much before I've got to pull the plug and say I've already overdone it for the day, okay? Well, if I've got all of my account on the trailer in one trade, then I can easily get knocked down to my day's drawdown in one quick swoop. And then what good am I? I mean, that's terrible. So, but the thing is, though, is when I'm day trading, I'm probably doing about 30 to 35% in a trade almost all of the time. And then part of the time, something like 60 to 70%, okay, and very, very rarely 100%. So, but the thing is, though, is that's a small account trading. That's not gigantic account trading. So, basically, the moral of the story is don't lose your money. Don't even get yourself in a position where you can easily lose your money, right? And, I'll tell you something. I can lose money, but I can easily come back from it, okay? It's not that hard. It's kind of like being a hitter in baseball. You can strike out, right, when you're good, but basically you can come back from the strikeout, right? It's kind of like that. Now, if you're not good, you know it. So it's kind of like that. You've got to be practicing in sim until you get up to speed, and you'll know it when you're up to speed, because you're not striking out every single time, right? You're actually putting more scores on the board than you are outs every day in every game, right? That's just the walks of life. Now, it's not like driving, right? Because you can go year after year after year without ever wrecking. Whereas in this thing, you're going to wreck, okay? Same with sports. You're going to wreck in sports, okay? And therefore, that's why you've got to keep your size down, right? You can't be putting everything in one tray all the time, at least not. And then, you know, you wreck it that one time. It just takes one time, you know. Those crabbers, you know, the fishers out there in the seas, okay, they always got to be keeping an eye on the weather and the waves, okay, because if they're sideways to those waves, okay, at the wrong time, the wave can knock their whole ship over. And how many times do they get? They get one time, okay? They don't get a strike 2 or a 3. They get flipped over and they're done. And they're so far out there and it's probably so cold. So that is done. And that's how it is in these markets, okay? And that's really more akin to how it is in the markets, rather than saying it's more like a dogfight in the sky. Because although sometimes it is kind of like a dogfight in the sky, because some of the time the real big size traders really are gunning at the weakness in the market, and they are trying to play you and trick you, right? So whereas if you're at sea, the weather is just the weather. It's not out there to get you. You're just there in it, and it's doing what it's doing. But the thing is, though, is if you get shot out of the sky, you're probably done. If you get your boat flipped, you're probably done. If you've got all your account in one trade, the chances are you're probably done. You know, another thing is, I've often told people that, look, if you know that you're going to be all right, why run? I mean, if you know that this is something that's going to do you well within 6 months, a year, or even a couple years, why push it? Why push the envelope? Push the envelope and practice and study and practice. That's where you push the envelope, and that's just how it is. That's this kind of job, okay? It's not like, well, it is like weightlifting, but it's like not like weightlifting. I used to enjoy weightlifting very much, and hard practice, and tree climbing, and hauling, you know, all physical work. All physical challenges and tests, and honing, getting my brain fixed up, getting all my muscles as elite as possible, as fast and long lasting and strong, right? All three. And I enjoyed that life. But then when I started trading, at first it was kind of cool because, wow, big numbers, worldwide, you know. But then after a while, sheesh, it was just a totally different world. And the thing is that I had to learn to hobble my legs. Basically, I had to kind of think of like a horse that's used to running races, jumping things, doing tricks for the audience. And then now I got to sit here and stare, right, and think, watch data, write, type. Okay, and so the legs want to go, the body wants the action, but you know what? The politics out there were killing my businesses. Okay, and so I've got to do something to make sure that I'm safe, and this is the safest thing that I knew. And so basically, I just had to wrap my legs and my horse legs in boards and then just hobble the horse, right? And it's frustrating, you know. Just wasn't my style, but some people are already working like this, so they'll adapt a lot faster. I'll tell you that. It's like learning a new language. You know another language, you love another language, but now you got to learn a whole different kind of reality. It's kind of weird. It's like you got to transfer into a whole new reality. And at first, everything in you says no. No. But you got to keep on making yourself do it. You got to keep forcing yourself in, you know, locking yourself down to that desk and just stay there and just basically try to hide. Hide there, hide yourself there so you don't know anything else, right? And just keep sinking it down into the brains. You know, and one thing that I was doing when I was first getting into trading was not knowing anything about trading. Thinking I kind of knew something, but I didn't know anything. And so being the hard worker, the athletic kind of person that I am, the 80 hours a week, non-stop, gung-ho, you know, rage warrior, just loving it and trying to get rich. I was actually trying to get wealthy and start things off all throughout my 20s and my early 30s. And then I sat down to trade. And so what's the first thing you think that the boss that's like that does when he sits down? Starts feeling guilty about sitting down too long, right? You got things to do. You can be doing stuff. You could be capitalizing, triumphing, adding it up, getting it done. And so that kind of initiative and that kind of energy transferred into this job is basically not good at first. Because what are you doing most of the time when you're trading? You're just looking for trades, okay? You're just learning and researching, and then finally you see it setting up, and then finally you make a trade, right? It's not like, you know, if you're constantly lifting weights, running, going to batting practice, going to throwing practice, play practice, cross-training in other sports, climbing, getting your dump truck ready, fixing your tools, going to the supply stores, checking strategies with the old-timey vets online that got their own businesses, dealing with the state and the executive stuff, the advertising stuff, working with the customers, working with the employees, collecting payments, yada 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 yada. And so when you get here, you're kind of like, you feel guilty because you're just sitting on your hands, right? Your whole life you've been feeling guilty about sitting on your hands, and now you've got to sit on your hands. And the whole job is just doing things that you would never, ever do, which is just sit there and watch, learn, and think. That's it. It's so alien. And so you start trying to trade. Right? You trade because you're bored. You trade because you feel guilty about losing that money. You got to make it back. And you wind up just slaughtering your account because you're not doing it right. You're not sitting and waiting. I hate to say it, but the actual way that you show the kids what you do in this job is basically click the mouse and say, see, watch me wait. And just sit on your hands. That's it. That's the demonstration. That's it. Not very exciting. And you know, I've talked to a lot of people, and really, I tell you, most people do not even want to come close to this job for that reason alone. It's abstract. It's too abstract. It's all information. It's not real. I mean, it's real information, but it's not, hands-on. It's not emotive, right? You're not being impacted emotionally. It's not sensational, where you're having sensations all the time. But I was into politics and stuff before anyway. I was listening to a radio in every single room in my house, and always the same conservative political radio station on the AM. And I completely stopped listening to music and entertainment TV. I would watch a documentary sometimes, or CNN, no, never CNN, but C-SPAN, right? So I'd watch the Congress and that kind of thing. And basically what I was just trying to do was learn what it's all about, how to vote, and how these people talk. How do the big players talk, okay? And so I was doing that for 10 years. And also I've been a writer for a really long time, right? Writing for days on end, sore hands, sore fingers, sore wrists, which is something that just kind of goes along with my athleticism, right? Constantly having something to think, having something I've got to put down, constantly grinding thoughts together, just grinding and grinding and grinding. And so when I finally sat down, after being in business, 2 different businesses for a while, in college as well, and I had to sit down and do this, and then I learned that this job was mostly about just understanding what's going on behind the charts and doing research on those kinds of things. And then after I was done with that, I had the opportunity to just work on writing and researching news, right? Which was something that I was already doing, right? With the radios, C-SPAN, the documentaries, and then writing. I was writing all the time. So it turned out pretty well, right? And so that's where the hard work's at. Otherwise, this is like, I don't know, this is like going to the store or something. This is so simple. Day trading is simple. Portfolio trading, the swing trades, those are simple. And then I don't believe in having a real big portfolio in long investments. But there are some that are so disruptive and huge that you ought to be in them for like 10 years, right? At least. Like the apples. So, and there's not many of those. But you know which ones they are. It's pretty easy to figure out. But that stuff is just like, it's like candy. It's like, if you're eating your food and then you get down to that new neat dessert, right? And maybe it's a couple of different kinds of desserts. It's some samples or something of a few different really, world famous desserts. So you can't wait to get down to that. That's what trading is like. That's what investing is like. Everything else is researching, writing, and then chatting, the discourse online. That's the big meal. And I enjoy that, so. But I've also got to do it. It's not like the contracting is doing really great. Residential contracting business. I was into bike cabbing while I was in college and after, and that business got sapped by politicians as well. So it was kind of a neat cash job. And I didn't get to go to the minor leagues. So, and it's probably best that way anyway. Those guys are only eating peanut butter sandwiches out there in the bush. Although I would have done it for sure. Absolutely. Alright, so I've gone on, showed you some day charts here. Oh yeah, I know. I was going to tell you about what's going on here behind all of these cues that we should be looking at. Okay, so basically, you know, you see this long-term pattern here. It's kind of toppy. You know, market's very overextended to the high here. It's kind of leveling out. You got a fail right here. Right? You got another fail. This one right here was really indicative. What does this mean? It means that buyers bought all these prices here that day, but on the same day, which is very quick on a day chart, then sellers jumped in and they took advantage of the opportunity to sell all these prices, take all the profit. Okay, they weren't necessarily interested in shorting. Maybe they were. I think at this time I was interested in shorting because I figured the market was kind of toppy. You know, summer was coming around, rates were going up, so on and so forth. Tax cuts weren't coming. The Osama Care thing wasn't getting repealed. So nothing was, you know, systems all messed up. So, you know, and this would have indicated that that was on the way. And so maybe there were some short sellers here. But basically, you know, you'd be selling here if you've got profits on this market. And take advantage of that new high there. But basically, if the market had closed up here, that would indicate this thing was probably going to break out up here over the top. Why? Because the bulls had bought here and they were holding here and nobody was selling, so everybody was basically holding, and they're holding for one reason: to make money over the top. That's the only reason why you buy, is because you anticipate prices being higher, right? And so if you know a whole crowd is going to watch the action movie, right? Or not the whole crowd, but maybe most of the crowd is going to watch the action movie. But then some of the crowd is going to watch the comedy movie, right? Okay. So basically what it means is that you can kind of tell what the crowd is about. It's not every single buddy that wants to watch the action movie, but it's most people. It's not every single buddy that wants to watch the comedy movie, but it's some people. And so you look right here and you can see that some people wanted to see this thing go higher, but then more people wanted to see this thing go lower. Okay. And so you got to kind of look at this thing like it's a large crowd. That's what a market means. It's a crowd. Okay. A crowd with opinions. What is a price? A price is an opinion about what? About the value of it. What are you willing to trade for whatever you're buying? What are you willing to trade for whatever you're selling, right? Everybody's got a limit. Everybody's got a go zone, right? You know, if it's this high or higher, right, then I will sell it. If it's this low or lower, then I'll buy it, right? And that is the entire world, right? The market is a crowd. It is its own industry. Okay, it's literally its own industry. And in terms of the entire system of the world, these Wall Street markets are kind of like the quantum physics realm compared to the rest of the classic physics world, right? Because what we do in here is fundamentally non-intuitive to everybody that we're servicing out there, okay? Right? And so that is how quantum physics is. Quantum physics is not intuitive to how things are on the classical physical level of things, which is where we're at. Okay? And so when you hear about quantum physics, it blows your mind because it's completely unintuitive. But that is actually how it's always been. So, so basically you're reading the minds of the entire crowd in this industry, in this esoteric industry, okay? Because it's by far not the majority of the world, right? You know, there's a thing that I say about this. Investing and trading on the markets like this is for the ambitious, and that is for sure. But it is not for the greats, right? Nobody will ever be remembered for making it huge in the markets, except for maybe Warren Buffett, right? Maybe him, but not necessarily, right? Very rarely does anybody ever become remembered for being an investor, you know. But what do investors do? They facilitate everybody, including the greats. When the greats come along and they have these great new inventions or these great new ideas, and they've got a lead with expertise, you know, a great slew of people in order to service, you know, a whole civilization, perhaps, right? And not just once, but perhaps for the next several decades or even centuries. Then it's going to take a lot of leverage, a lot of capital leverage. So therefore, the most ambitious of the financial wizards, the investors, would be summoned to help lever all of the costs of all of the labor and materials in order to facilitate this great undertaking, whatever it is. Okay, and that's who's down here. And then you basically divide this up into day traders and swing traders, and then long-term investors, right? So long-term investors, they've got the giant mega hedge funds and the banks, and then sometimes they're just, you know, they've got a lot of capital privately themselves, but mostly it's institutional funding, right? Institutional investors, companies that do this, and this is all they do. Okay, so the way that works is basically the short time, which is swing traders and day traders. Basically, we're kind of like the elevator people in the system in here, right? And so these are like the elevator shafts. Okay, so when the long-term investors want us to go up, they will show us, right? So that's what we're reading here at these lows. Higher low, higher low, higher low. Multiple tests lower, all tests fail. Quick tail. Even after some quick wicks right here, halfway back up the gap, right? Almost all the way back up. Still, the test lower failed. Okay, so basically that's the long-term investors hitting the elevator button, okay? And then basically, well, what are they actually doing? They're actually buying this, right? They're accumulating positions, okay? And so we're going to go with the majority of them, and we're going to take their cues, and then what we're going to do is we're going to say, okay, well, it looks like it's bull, so we're going to go ahead and buy, and then it's us that start pushing these prices up. Anytime during the day we buy the dips, right? And we just keep on adding to the position. They also keep on adding to the position, okay? And then this thing will run. We'll run this thing until we get the sign that we've got to go down now. Now, take this whole flat area, right? We're at the very highs, right? They call it nosebleed territory, as in we're so high that our sinuses are bleeding, right? And that's kind of where we are at, way up here. So overbought, no real corrections, okay? And so we're kind of flattening out up here. We did dip down kind of low twice over here. Systemically, we're kind of shaky. And so, you know, with all things combined, basically, we're going to start trying to test lower. And that's basically what we do. We get ready to test lower, and we also stop taking the thing up. Because the people in the elevator are saying, okay, we're not going any higher. It doesn't look like we're going any higher, so we start testing lower. And when we do, we take the thing down, right? So, you know, you and I aren't going to move the market, but there are size traders out there that day trade and swing trade, you know, with multiple millions of dollars each, hundreds of thousands of dollars each, and it's a lot of people, you know, relatively. And so we knock these prices down, and then the long-term investors go, hey, I'll buy that, yeah, I'll buy that, because they're looking out here. And so look at this. In order to get higher, right, we wound up higher here than we were all this time. In order to get higher, what did we have to do? We had to go lower first. And that's how bull markets are. They become overbought, and in order to get long-term investors to buy again, you've got to knock down the price. Now, if you're a savvy investor, that's okay, because you're going to short sell on the way down, and then you're going to buy long on the way up, right? Because you're the elevator traders, okay? The long-term investors were probably taking profits all this time, slowly and methodically, not too much at a time, right? Take some profits, let the price come back up, take some more profits, let the price come back up, slowly and methodically, quietly and stealthily. They've even got algorithm programs constantly working all of the stocks in these markets, all the way across the whole thing, doing this exact thing, taking more profits and never letting price get too low, okay? And they will range the thing as they get into or out of a position. Okay. So that is who are behind all of these bars on these charts. Okay. As far as the MACD goes, it's a ratio. So the longer the bar, the brighter the bar relative to the other bars, and red means that there are more sell contracts than there are buy contracts. The length of the MACD bar indicates how many more, right? So basically, you imply that there are green bars here, right? But they don't need to be green bars here because you already know there are some buyers anyway. But in fact, there are sellers here more than buyers here. And the length of these bars indicates just how many more sellers there are than buyers. Now, this is all relatively speaking. It's not like the volume bars where there is a specific amount of contracts that were exchanged in that candlestick to accumulate that much volume, okay, which is a specific amount. On the MACD, it pertains to basically a relative amount, okay. But if there are well, how about this? If you've got 1 part to 2 parts, 1 part to 2 parts buys to sells in a volume bar here, okay, that means that, let's say the 1 part is buys and the 2 part is sells. What does that mean exactly? It means that 100% of the total volume is buys and sells, but basically it is double whatever the buys are, right? So the buys, the sell orders are 100% more than all the buys, okay? So now that is a relative term, right? I mean, how many orders are there? Well, you look at that up here. You don't look at that down here. All you do on the MACD is look at how many parts is sells, how many parts is buys. That's it. And this goes back only, I believe it's 13 bars, okay? And so it's all relative to 13 bars, okay? And so basically this is taking into account all of the ratios all together, and then each bar as it comes out is compared to the last 13, I believe. And on this MACD, you've got to note that I've got a MACD histogram and a regular MACD line. Actually, it's 2 lines for the MACD line. But the thing is, though, is that I learned from one of the prop firm traders, long-time prop firm traders, that basically the 2 lines just give you too much data, and it messes with your mood, and therefore it messes with your trades. So make it 1 line, which you would have to actually set the settings on the MACD line for this number, these 3 numbers here, 5, 13, and 1. Okay. The histogram you just leave as it is. Okay, so wait, so that's 5, 13, 1 for the line, and that way it's 1 line and not 2. Because once you get the 2 lines there and it's crossing over, that's never consistent. It's just extra data, and it will mess you up because you'll try to read it and then it'll change your mood, and then you'll wind up messing up your trade. So just get that data off of there. And actually the MACD histogram right here, it says looks like it's 26 days, which is a whole month. I am not sure about that, but I know that it's a couple of weeks, at least a couple of weeks. And actually we could look that up real quick. Yeah, it's 12 days compared to 26 days, so basically 26 days. And then it works out its ratio. Right, it's an algorithm. It's an algorithm, and then the results of the algorithm are plotted on the chart. Okay? And so that data that it's finding with the values that are coming out of the exchanges, okay, is plotted in a visual form for you. That's the point of the charts. Otherwise, this data just looks like numbers on a sheet, right? And it's hard to determine, you know, whereas this basically imagines it for you. So rather than you having to take in all the data, do all of the algorithms in your head and then try to remember all this stuff from day to day. This imagines it all for you and then remembers it for you as well forever. Okay. Therefore, that's a leverage, right? So you're actually lifting a lot of thinking and remembering and researching, right, with a simple, computer output here. That's leverage, right? That cheapens everything about this job. And therefore you profit more, you profit faster. That's how leverage works. Technology is leverage. So is cash. So is knowledge. And it's all based on information. So anyway. Okay, so now basically what this means is that right here, the ratio of buys to sells came down to 1-to-1. I don't know how many contracts, and it will vary. But when the MACD turns from red to green, the ratio has flipped to 1-to-1, and then it flipped over to the other side where the long or buy orders actually start. I shouldn't say long orders because there's a lot of shorts that are buying to cover, and that's not buying long. But basically the buy orders executed wound up becoming more than the sell orders. Now you could have a lot of volume. In fact, you could have a ton of volume right here where it flips over. Okay. But they were evenly matched. Okay. And then the buyers prevailed over the sellers, and so this becomes a bullish market. And so you got to watch those kinds of things. Basically, what you do is you look for divergence, and that means that price is running one way and the MACD ratio is running the other way. And as you can see, the price is still bullish on the chart, but the trading ratio here is less and less bullish, shrinking less and less and less, down lower and lower and lower. What that means is that price is going one way and the bullish ratio is going another way. And so which one do you believe? You believe the ratio, right? So what's the team actually doing? What's the price doing, right? The price is superficial. The MACD is sentimental, right? Or the mood, or the actual MRI of the entire industry. And basically that makes sense because the best buying was lower. The worst buying is higher. That's how it works. Because why? Because once you're already high, what do? You go back down low. Once you're already low, what do? You go back up high. Okay? And therefore you just won't have as many buyers up here than you would down here. Okay, makes sense. So if there's a road ahead, then you put in money. If there's not a road ahead, then you don't put in money. You actually put in money the other way. Now, as far as the bearish ratio here getting worse and worse and worse, that also is something you've got to keep in touch with, but it doesn't look like it's getting that bad here. Okay, so these sell-offs here did not become too bearish. So maybe it's not too negative, although I just don't see this thing going on and on and on. I see this thing checking soon, or correcting, which basically means that that well, if there's enough holders here, it won't correct very much. But basically, in order to get more buyers in here, you've got to see the thing check. You know, you've got to find value down here. And basically it means that, okay, would you buy a whole ton up here? No. Would you buy a whole ton down here? Yes. So why don't we take the market down here, and then we'll get buyers and it'll come back up. And that's just how it works, right? We're overpriced up here, underpriced down here, so price checks. And you make money on the short side, buy on the long side on the way back up. It's kind of like that. Okay, I think that's enough of that for today. And now all that stuff does kind of transfer into the 5-minute chart, okay, for the most part, but on a different dimension or a different level, okay, because it's all shorter term. Now on this level, you've got to deal with, you got to be concerned about the overnight hours on the Globex exchange. Now these futures trade on the Globex overnight, and then on the regular session they trade in Chicago, right? Futures are American. Then you also take heed of what the day before did. The other thing you got to do is look at volume profile from previous days. Not the overnight though. Don't look at volume profile for the overnight because it doesn't really matter. Just note whether or not there was more buying or more selling. Just look at the chart and see, you know, is the inventory long, or is the inventory short, or is it neutral, and then kind of base things on that. And then, you know, 4 days of the week, the first 4 days of the week, a regular week, basically all the trading, all the good trading is done about 2.5 to 3 hours after the opening bell on the equities. That's the stocks. And then after that, it becomes fairly thin. The market becomes fairly thin. Everybody goes home. They take their profits, or they just they call it a day after they've made some losses, and the market becomes so thin, and they're just not going to put more time into it because it becomes more risky. And then on Friday, that dry spell happens a little bit earlier because people are already gone for the weekend, and they know that they're gone. So people know that they're gone, so they leave earlier. Right, and everybody just expects a short day on Friday. The holidays, very thin markets. You won't even have a good morning. It'll just be a dry market all day around holidays. Sometimes before Fed meetings, things like that, big deals in the macro system. Market can be pretty dry up until then. And it'll behave accordingly. So if it's going to happen that week, the previous days in front of it will behave accordingly. You'll either get some sporadic buying or some sporadic selling. The market, you know, shifts in those directions because of those sudden impact trades taking off on there, and so that's to be expected. Otherwise, things are fairly routine. But if you've got something big happening, expect something big to happen out of the norm. Okay, so let's take heed to the levels here. Here's our swing high. Here's our swing low. These are the openings, as in the open swing high and the open swing low. So how's our opens here? Basically, these open swing highs and open swing lows are all about basically the first, I would say the first maybe hour, perhaps hour and a half at most. These are 5-minute bars, so 3 of them is 15 minutes, 6 of them is 30 minutes. Yeah, I would say the first hour max. And basically, once you see it play out, the open swing, the open swing low, the open swing high, after a while it just becomes intuitive. But I mean, you don't look for an open swing after it's gone up quite a ways, it checks back down to the median line or even lower, and then it comes back up. No, the first high was the open swing high. This is never the open swing high. This is repeating this. Okay, the market never went lower than this today, so obviously that is the open swing low. There's an obvious open swing high and open swing low, and sometimes it's tricky. Sometimes it has to do with the team behind the scenes in regard to basically the day trading etiquette. Okay. And it would take some time to learn that, but eventually you'll start to see it if you are focused on what is the trading market thinking about when they do things at certain times of day, from day to day, and you are gaining that basically listening to the music through the candlestick bars, volume bars, the indicators, the news, other traders. Okay. Now this looks fairly bullish here, in fact. So, we've got open swing high. It tests lower. Kind of late already, so there's not going to be much of a move here if it does go high. Not too excited about the S&P though. I don't think it'll go very high. If it goes higher than the swing high, finally. But let's take a look here. We've got this new low here. And basically what you expect is it to make a new low, come back up, and then try to come back down to that low and then break through if it's going to be bearish. Okay, that was not the case. The thing came down just a little bit there, got a quick tail, and then suddenly it's a series of higher lows. And then what do we get here? A double top. Obviously it didn't break out, so when it didn't break out, they sold this thing off, right? Basically the thing didn't have any gas. Okay, which means basically there's just not a lot of participators. Right? There's not much of a team here to carry it past the open swing high. So as soon as we saw that this thing wouldn't go over that, team said, nah, get out of this trade, go home. Smacked it down, just sold it off, whatever. Right? But then obviously there wasn't a whole lot of sellers there either. So when they closed out there, basically we just got down to the 34 EMA line, the money line. That's kind of the median line, the middle of the road, and bounced off of it perfectly, and then runs back up for a triple top, right? And then what do? Nope, no way. slam it back down. Big, quick wick right there, okay, right? So we get some consternation here, but then we start developing higher lows, higher lows, higher lows, and now we're running back up into this resistance here. So this is a very persistent market. Also take a look at MACD down here. This thing is about to turn green, right, which is bullish. So there could be a series of stops here, perhaps, or it could just be some more sellers waiting there to smack it back down. So I'm not too eager about that one, but I am thinking bullish. Here's the NASDAQ. Okay, we've got the open swing high, open swing low. Well, hold on. Yeah, I think this low right here is early enough. And this second try up here was not great enough to say that this was the open swing low. So I'm going to call this the open swing low here. It's early enough. This test up here was not great enough to say that this is the open swing low. So I'm going to go with this one. Basically what it means is that if you've got price up here, then things are bullish, right? If you've got price down here below the open swing low, then things are bearish. And that sets the mood for the day traders. Now, that's the sheet of music that the orchestra's on, right? And that's what we're all on. And until the chart says something erratically different, that's what we're playing to. That's the song that we're playing. So make sure that you're reading the music sheet here. This is the music sheet, and then you're playing the same thing on the same tempo, that kind of thing. And you're reading. You're knowing the difference between normal day traders' routines and then out of the ordinary long-term investors, which are signaling something out of the norm. And then start adjusting to them, right? Because that's what the short-term traders are going to do. They're going to adjust to them. Basically, the long-term investors, the institutional funds that put in the big truckloads of capital, they're the maestros, okay? So we kind of go with them. That's how that works. But until we see something, you're going with the team, which is the short-term traders. And they go with us as well. If they have a big position and it's going to take a long time to enter because they don't want to shake up the market, basically what they'll do is they'll let us move the price. They know that if the price goes up, then the price is going to come back down because we're going to take profits. And so what they're doing is they're waiting for us to bring price down, and then they'll buy it back up, right? If they're bullish, okay? Or it may be vice versa. Okay, so that if they're bearish, they just wait for price to go back up and then they sell again, right? They're going to get out of their position or whatever. But basically, they're going to wait for us. So we do the work and then they wait for their prices and then they fill in, okay? And we're waiting for us. We're following us. So we can read us, they can read us, and then it's just kind of a symbiosis. Now, if the long-term investors need to cut corners, right, and really cut the carpet out here, down to brass tacks, then we'll see some volatility, right? Some sharp bank turns, like the jet turns sideways and then banks off of the wind, to left or right or whatever, sell or buy, so we'll get that in here too. And then that's basically telling us which way we're going. We're going to read that. Everybody reads that as well. Even the other long-term investors read that. So that those things can kind of change the song, right? From hour to hour, day to day, week to week. Okay. And you just add up all the data, and then you know just about where the song is. You can anticipate what's probably going to be next, and then you go with that until you know something else. And the most recent data is the most important data. Okay. But previous data that is still fairly recent is also important, but not as important as the most near data. Okay, so swing down here. We get a bounce up, and then we expect to fall through support, but it doesn't fall through support. Instead, we get a higher low here with two quick tails here. So that is basically saying that these prices sold, but then they bought real quick, right? So when prices got cheap here, bulls bought up real quick, and they took advantage of that. Prices tried to get lower again, they sold again, but bulls got greedy and they bought them back really fast. Basically what it's like is like you're dropping some fishing bait down to a certain level in front of like a little ledge or something, right? And so the fish are underneath that ledge down there, way down there. And so when we get down to that level, that many feet down below the surface, or those prices, then they start biting, right? That's when they start biting. And so then we reel up the price here. Okay. And that's what that's meaning. And this time they were so hungry this time, right, for these lower prices, that they didn't even wait for the market to get down here. They came out up here. They swam up and got these real fast, right? So that's indicating that they're very greedy. And basically, if you flip the script, what it means is that when prices got to here, nobody wanted to sell anymore. They didn't want to sell these prices because nobody was looking lower, right? And so basically the lake is upside down when you're thinking bearishly. Now, if this is new to you, that's not going to come intuitively. But once you get it, you just flip the script and then you think it bearishly, and you'll think it, right? You'll think it the right way. So go on and on. A couple of hours of trading a day, no problem. Basically, this deal right here would be your most recent high. Okay, so that's going to be your resistance now. And so market tests lower, fails, comes up, and then it's going to bounce off of resistance and then work its way higher and higher, higher lows, higher lows, higher lows, until it starts breaking out of resistance. But this is such a meager breakout of resistance, right? This is a very bad performance. Hardly even a move here. So not very interesting. Okay. I would say on a market like this today, I would be interested in perhaps a breakout up here, but not down here. Okay. Because there's going to be a lot more stops up here because of risk adversity, right? Short traders are not going to be seriously afraid of price backing up here, but if they are short, they may seriously be thinking about price backing up this far, which is too far. And so when price gets up here, it may hit their stops, and therefore you will get some buying to cover, which should push prices up, at least enough to make a trade. And that would be where I would be interested, but not down here. This is so fizzly, not sizzly, fizzly. It just fizzles out right here. So this is these price movements right here, so small and meager. And look at this volume; it's so minuscule, right? PK that it's too risky. It's so risky. So NASDAQ market pretty much looks like a done deal. I'll just leave that on. Take a look here at the oil, CL. Here's the swing low. Now that's not much of a swing, but that's it. Here's the swing high. Okay. And that sets the pace for the day. Okay. So market up above here, above the swing high level, bullish. Market below here, bearish. Everything in between, just a range day. Okay, neutral. Hold on. Alright, so swing low down here, swing high up here, come down, check the median here, 34 EMA. We got a quick tail right there. Quick tail means there's some bulls biting right there, and so we get a bit of a short squeeze here. Good sized trade right there. I'd take that. You've got, higher low, again another higher low there. So this thing is looking good. I would be biting that, making a trade there up to resistance, not through resistance. Okay. I would be interested in buying above resistance, perhaps, but I wouldn't be holding on much below resistance. Not in this case. A very mundane, slow trading day. Not too exciting for everybody. So now then, when I see this quick wick right here, and I have no reason to think that the team wants to go higher or even could go higher, because there's just not enough traders to keep it rolling higher, then I go, okay, well that quick wick right there, they bought it up, but then they sold it off too fast. It tried to break out, but then it failed miserably, right? So that was a double top. Failed miserably. This is looking pretty short, okay? So basically, I would be looking to make a support line. This looks to be it. I've got about 3 bars here. Down, bounce, bounce, down. Lower high right here. Couldn't even buy these prices right here. Okay, so basically bulls are going out of business. Failed to break out here. I mean, it peaked out, but then it couldn't break out, and we're down here. Breaking through support, so now we've got bearish action here. I would be interested in selling short right here. I would grab a trade out of this one or this one. Basically, when the thing starts coming back up to here, I might just go ahead and exit as it goes back up there. But once it gets back up there, I will be interested in shorting again. Okay, and sure enough, comes back down to here. That is another trade. So basically 1 trade, 2 trade. Wait and see what it's going to do. Now this is still resistance. Okay. Got the double top there. That's a reversal. Now you got new resistance. Bounces again, shorted again. Looks like it moved pretty fast down. Okay, so even bigger trade here. Get more than what I was expecting, and then get out of it as soon as it starts talking about reversing here before it takes my money back. Now, do I hold on much longer? Could. You know why? Because we just reversed here. This market just reversed. So this thing has not gone too many legs lower. Right? You got a reversal. What should I call that? A reversal cavity or a reversal range. I guess we can call it a reversal range, which is this area, okay, where the double top is, and it would be the double bottom if this thing was reversing bullishly. And then you've got 1 leg down. Okay, so it's just 1 leg down. I would go 1 more leg with this thing, and then I would be done with this direction, especially on a thinly traded day like today, this Friday. Okay. So basically, we break through, bounces back up. Looks like it's bouncing off of resistance here. That is definitely bearish. The trend is to the downside with no hope for bulls, or just no interest from bulls. And then grab this as fast as possible, make that first trade. It'll start talking about reversing. I'm done with that, and I'm actually done with this direction. Now, the thing does actually continue on down, okay, but I am not a gigantic trader, and I am not interested in taking those risks, because basically if I'm not just snatching what I've got as fast as possible and then done with that trade and looking for another trade, then what I am prepared to do is trade defensively. And I would prefer to have much more capital to do so. So if I get caught backwards here and price reverses on up, then I want to be able to scale in, right? And so add more position, more short position, and then start working a defensive strategy where basically if price gets back up to here, I look for a bounce and then add more, double it or whatever. And then once it gets back to break even, then dump the first part of the trade that was losing. And if it profits, take profit and write it on down because it looks pretty bearish. But if it just bounces back up to the second entry, okay, and then I don't make anything on that, perhaps I repeat the same thing. If price continues higher, then I'll enter another short up higher, and I will try to average out so that I work myself down to just one part of what I trade, just the basic minimum of what I trade. So if I break my account into 3, I want to get back down to 1 part, and then I will try to see if the thing will continue on down. But by the time it's up that much, perhaps it's already too bullish, and perhaps this is a game in vain. You know, I'm trying to short in vain. Okay, and so therefore maybe I should be looking for a long position and looking for bounces off support and then breakouts through resistance and be long. So that's defensive trading, and you can do that with 3 contracts or whatever, but it usually costs a little bit more. Okay, I don't know. Practice it, see if you like it. If it's not so bad for you, maybe you do really well. I do really well sometimes, but then sometimes on a small account I do poorly. So look forward to that. when I do well, I do probably about 2 or 3 times what I normally make otherwise with these fast snatch and go trades, right? So I'm not really scaling in and working back up or any kind of defensive moves. So there's that. And basically the main idea is that if you're getting backed up into price, you're not going to be backing up forever. Eventually the chart reverses, right? There's no way you can keep going up because profit takers are going to come in and take charge of the chart. Same way with the other way. Shorters eventually are going to take charge when they start taking profits, and the thing is going to reverse. Okay? The thing is, though, is that if you're getting backed up all the way across the chart, and then you get a reversal, and it's not nearly what it was on the way down, then you kind of missed out on all of the action already, and it's costed you all the way down there, and then the action doesn't even bring you up nearly as much, so then you don't make that much anyway. That can happen, okay? But if you were right to begin with and you shorted all the way across a bearish chart, that's going to be a very profitable day. And then two, sometimes these things don't ever reverse, right? So if you've got a high to low bearish day or a low to high bullish day, which means that the market opens and it never comes back down ever, and then closes at the very high, right? And you were waiting and backing up and scaling and backing up and waiting for a reversal, and you were going to trade the reversal. Okay. Well, that just cost you, right? You could have been trading the bullish day all day. So maybe you figure out, okay, well, maybe this is a bullish day. Maybe you don't. Okay. Or the other way around, where it opens and then it closes at the low, and you were long, and then you just keep on getting backed up more and more and more. What I suggest you do is work on that, practice it, take the hits, get the feel for the pain, get the feel for the gain, okay, get the feel for the daily routine, the levels on the chart, and then combine two strategies at the same time, so that you're taking the fast snatch trades, but you're also trying to back up into one of these long trades where it's taking you all the way across the chart. Okay, that works out. Now that's going to take a lot more concentration, and if you're doing that, if you're trying to do both at the same time, I wouldn't try to trade multiple markets at the same time. Okay, just focus on one, stay with it, watch all of its breaths. That seemed to work the best for me. If I started to try to trade maybe NASDAQ and oil at the same time, or oil and euro at the same time, then I started to dilute the sense of what the music was telling me on these charts, and therefore I wasn't able to cut the corners like I should have. And then I'm looking back and I'm going, well, why wasn't I why didn't I make that move right there, and that move and that move? And I just realized that basically when I'm combining the data from two different markets, it messes up my trades. Whereas if I'm just doing fast snatch trades off of these levels, like what I first told you about, I can trade multiple markets. It's very easy. The data doesn't mix up. It's not as intensive, I guess. Because you're really not managing that much size. You're also not having to take account of both trades on both sides all the time, right? The financial engineering aspects going off in your head not nearly as dynamic, okay, while you're computing all the other data. So it's easier that way. Something to think about. What I should do is I probably should make some diagrams, okay, and then just have a whole lesson about just those kinds of trading, those kinds of trading strategies. Okay, and it's something you can do for a beginner. Just practice on the sim because you're gonna get wiped out at it. And then, you know, I'm sure it's up to individual traders. Like some will be better and some will not be as good, and then some will learn faster, and others are just going to have to stick with it even longer until they get it, that kind of thing. Okay, so anyway, yeah, so after this bounce right here off of resistance, I'd be done. I'd grab that trade and I would be done on a day like this. I would let it run down. It finally bounces down here a little bit above the swing low, the open swing low, and then we get this quick tail which says that once the fishing line dropped down here, those old bull bass came swimming up and bit the hell out of that line. Okay, and then, you know, so then what do bulls do? They start reeling up. What do bears do? They start buying to cover, and they're probably going to start buying long to get a long trade. We just got to bounce off of the open swing low down here, which would be like a double bottom. So the chances are that there's going to be a bear trap somewhere around here. And bear trap means that basically the shorts have to get out of the market because they're going to start losing their profits, right? So when they start to buy to cover to get out, it pushes prices up for all the longs. Okay, then it becomes profitable to be long, so they'll probably buy long too. And so the bounce heads on up, and then we get up here to the top area. This becomes the resistance, right? So what we'll be looking for is an exhaustion here where the bulls take profit. Nobody's going to buy any higher. Price will fall back down in. Okay. And then a return to resistance. Looks like the thing tried to break out here and then failed. That right there would be sending a signal like this market was bearish. Okay. So basically what we've got here is a good run down. Okay. And then up here tried to get through resistance, but then quickly sold off, and sold off quite a bit here. Okay, so that would be sending loud bearish sounds into the song, right? And it would be kind of hard to buy long here, but then we wound up seeing that actually we get the reverse here, and actually we're getting higher low, higher low, higher low. And so once we get up here and we're seeing this is a little failure. This little quick wick is a failure, but then it comes back down here and we get another higher low. Now I'm looking for a breakout and, you know, a bounce off of this thing. And so I can get that with this one right here. This would be my trade right here. That would be it. And then once it starts talking about reversing, even before this bar closes, I'm out of the trade. And so that would be all I would be looking for, especially at this time of day. This is 2.5 hours after the open on the equities. Okay, so basically people are gone home. You don't look for big moves, you look for small moves. Okay, and just keep on working and making your pay, and then wait for it to set up again. So that's what it's still doing. It's waiting to set up again. This is now the new resistance, and this right here is the support, which just happens to be this support. Okay, And so we'll see what it does. Maybe it breaks out here, maybe it breaks out here, maybe it just ranges all the way to the close. That is to be seen. Here is the 6E. So we've got a open swing low, which doesn't look like much of anything, does it? Look, see that little tiny tail there? Okay. Well, that's it. Open swing low. And then here's the open swing high. So that basically sets up the music sheet. And then we'll see what song they're going to play. They're going to play the neutral. Okay. In between the swings. So you got a quick tail right there that indicates fast profit taking, right? Fast profit taking. Not a lot of support to keep going, but let's keep listening to the song. Hang out here for a good half hour. Never coming back up here to touch the open swing high. Okay, so traders get bored, they hit the market, they sell off, just close it out, they're going home. Now this is the euro, and remember most let's just say half of all the traders in the euro are not in America, right? And their markets close at about 10:30 Eastern time, 9:30 Central time, 8:30 Mountain time, and about 7:30 Pacific time. Okay. So if half your euro traders are out already at that time of day, okay, then just kind of figure that this one becomes a dud a little bit earlier. Now it's not always a dud super early, but just kind of figure that the gas is already gone fairly early in the day, earlier than the other markets. Okay. So basically this becomes your new resistance. This becomes your new resistance. Basically, these get hit right here because they're tired. They're done with it. It's not going back up there. This obviously is, you shouldn't be long here. Short it. Don't be long it. Sell it. Get slammed down to here. Down to the EMA. 34 EMA. Middle of the road. The money line. Okay. Tiny little quick tail right there. And then you start seeing higher low, higher low. So we're going back up to resistance. So this may be worth a trade. Check it out. You get a bounce off of that one right there. I would buy it. Okay. There's a trade right there. Got that bounce off of resistance. You got a lot of bullishness right here off of the 34 EMA. Probably going to be touching resistance right there. Sure enough, touched resistance. Tried to break out. Couldn't break out. Fail. Okay. Meaning that these prices are just not selling. In fact, these prices are selling. Basically, these prices are just not buying. Let's say it like that. Okay, trying to be as simple as possible. These prices are just not buying up here, but these prices are definitely selling. Okay, so it's just saying that okay, maybe lower prices are better, you know, and but definitely not higher prices. Because if these were buying right here, past resistance, if you're breaking out, these are selling, buying. I mean, then basically that's indicating that there's probably profits up here, right? No, that's not the case. So then this was support, test below it. This right here is kind of hard to trade. That looks pretty confusing. So basically what I would be doing is I would be looking for a breakout either through this resistance or through this support. This is actually kind of confusing, kind of risky chart. It's not worth as much. Basically, when you get into this kind of confusion like this, the value of the chart goes down dramatically. Okay. You just got to wait for it to set up properly. All right, so if this is, let's say this is the new resistance, or that, okay, then this is the breakout. Now, if you buy this, or if you sell this breakout, you short this breakout here, or let's say you short this bounce right here, right? So try, all fail. Short this down to here, and then you short this breakout here. It's 2 little trades. Okay, not bad. You're still making money if you're savvy. Fairly confusing though. So the value of the things are just not as much. So if you've got a good sized account, basically you would want to reduce your size until things are more sure. And even still, you got to figure that these are such small moves that you've got to be able to get in and out. So if you've got a lot of contracts, basically what that means is that you've got to have enough of the other side of the market to get out at your price. So if you're trying to get out of the market at a certain price, but basically there's not enough buyers or sellers on the other side of the market at that price, okay, that means you can't even fill the entire order. So you're going to have to compensate or compromise. I mean, you're going to have to compromise on price and take a little loss or a cut off of your profits. So it's kind of like trying to fit a long semi truck around curves in the city. Okay, so you've got to be able to compromise and anticipate these things before you get into positions. So if you're getting into a tight position where the chart becomes riskier and less certain, like through here, then you want to reduce all your size down, so that way you're able to get out without too much slippage, right? Otherwise, these small trades won't be worth anything to you because the slippage will be worth the cost of the slippage will be worth the same or more if things don't go right for you. Okay, but if you've got fewer contracts, the slippage costs are reduced that much more, and therefore you can get out with a profit or at least break even, okay, but not some kind of big loss. Okay, and then so now we're back down to here and we get a double bottom, and it's a double bounce too. So we test low, comes back up, tests low again, and it's a little bit higher. See there? So basically it just means that these prices down here at the bottom of this wick, they couldn't sell those. Okay. So because as soon as they came down here, then the buyers started buying those, right? They came up. They came up from these lows. They swam up like fish to buy these higher lows, and so grab those higher lows and then start making way, and you know the story, higher low, higher low, higher low, but where are you going to buy? Well, I would suggest that you make this right here where you've got 2 bars, right? They bounced at the same place. That's the nearest level of resistance. I would say that is resistance. Basically let price break out on this one because this is kind of a funky chart. You could say this is the double bottom and buy it on these higher lows, make a little trade here. But the thing is though is wait for it to break out and then bounce and then head on up, and that would be what you get here. And so there's a little trade right there, just a little trade. We aren't talking about huge trades here, right? And then all of this is just all fizz. I mean, this market is asleep. So all the action is here, right? So what is the action? It's the up and the down, up and the down, and then what is the sleeping market? It's just these barely any price movements, sideways movements. Okay, the candlesticks are very small. Look at the volume, just falling asleep here. All right, so let's check on the gold market here. Let's check overnight. Looks like neutral overnight. The day before was bearish. Let's look at the overall daily chart. Okay, we were getting fairly bearish here. This was actually getting lower than I thought it would get. I guess this here would be a support, and it is turning around before it gets to it. We've got to break this trend though, so that will be the test. If it breaks trend, then we'll test this resistance, but we're already breaking this resistance. Okay, so we'll see how it goes there. My assumption is that we test this resistance up here. Okay, and so that will be the big signal or the line in the sand. If we start breaking out through there, then we start getting into emergency modes. The Fed may come out and lower rates, who knows, or just say something that indicates lower rates or whatever. And so then gold will come back in probably. There are the big banks that actually hold down these gold prices with hundreds of trillions of dollars, which is just basically funny money because the banks make funny money. That's what they do. And they've got government sanction to do this. So basically they try to control gold price so that way the dollar and the rates don't get out of control, because if gold gets up too high, then it indicates a lot of risk or panic. And if this chart shows there's a lot of panic in the world, right? This is a world market. Then the dollar is going to get out of control. That's the reserve currency of the world. Something like 70 or 80% of all of the currency in the world is traded in the dollar. And then what controls the dollar is the interest rates, which is controlled by the Fed Reserve Bank, which is the central bank of the U.S. And really it's a European central bank empire, and that's just one of their branches. A branch near you. So what do we got? We got a little reverse here. Maybe we're looking higher. I don't know. I think that we're going to test 1300. I think this thing works its way back up there. I don't think that it necessarily goes in a straight line, but I think that we work our way back up. So I'm bullish on gold. I'm bearish on the equities markets, and I always am bearish on the oil market. I just don't think there's a future on the oil market. Because of technologies are so far along, it's just in every direction, is just obliterating the oil prices out there, and it just can't stop. They can't. The industry cannot get out of its way. It's impossible. It's just the laws, the dynamics of reality. And that's just the industry that they're in now. On the other hand, Technology's coming out to make alternative fuels. Driving is not so much anymore. Cars are not selling so much. And basically a lot of that has to do with people getting poorer because of the stupid Marxism in politics and everything killing us. So basically they take away our jobs here so people don't drive as much, they don't buy as many cars. They put all of our jobs everywhere else in the world, and they are not in consumer economies. They're basically just kind of like slave economies, right? Ran by communists to make stuff there and then sell it here and then borrow more central bank money to pay for it, right? So the international corporations, right, and the Chinese corporations and the Chinese government gets rich, okay, and then the central bank here gets rich, but the America gets poorer. And it's the same way in Europe. It's actually even worse in Europe. So there is a reason, what do they say, method to the madness, and it is madness, okay, because it's not intended to go good, right? Remember, solvency is competition, right? If you are solvent and you are free, then you are competition. So they've got to bring you down, and that's all that's about. Now, once you understand the big picture, now it took me years to understand the big picture. Not a ton of years, but it took me a few years. It's pretty amazing. Even though the system's broken, it's kind of amazing to see the entire system. And given that it's so complex and it is esoteric information, right, hardly anybody actually understands it, then it hides. It can easily hide away. And so that is why they can get away with what they're doing for so long. I mean, this is what they've been doing for hundreds of years. So time will tell what the consequences are, and I don't believe it will be too long from now. But anyway, we get, yeah, I guess this is the swing high here. And we'll try to hang out up here. This is the open swing low. So we're kind of hanging out up there. Basically, the market's also walking on top of these levels here, right? Because these are actually the day chart levels. That's what these are. And so they're just showing up on the 5-minute chart as well. So they're trying to walk it out here. They did try to break out over this. Failed. You got your big quick wick there. Failed there. Failed to break out. Reversed. That kind of thing would tell you that that was a double top. It was also a failed breakout and a quick wick. Probably going lower. You would look for a breakout. Probably look for a breakout here underneath this one. Oops. I think I'll use the line. Yeah, those day levels, day chart levels may get in the way. So basically this one right here, once it broke out through that, then you're talking about a short. You may get a little short there. It may be so small that when the market reverses that you just don't make anything. And then these are just such picayune little, little price moves. There's just nobody in the market. You might just bail out on that. So there's not much going on the gold today. Alright, I guess that's about it today. I've been meaning to make some diagrams and just focus on the trade strategies, some defensive trade strategies, basically kind of like the dog fighting of day trading, which transfers over into swing trading and long-term investment portfolio trading. Okay, so basically everything you learn here at the day trading level all transfers over to the longer-term trading. Okay, and to be honest with you, these things transfer over into, if you wanted to run a small business or manage something around the house or have a project, whether it's just you alone or it's your family or a group of people and that kind of thing. Basically all these things kind of transfer into how you manage everything in your everyday life. So the skills you learn here do transfer and are good for other things elsewhere. Basically it teaches you how to be constantly drawing a line in the sand, constantly assessing the value of what you're doing, and constantly insuring yourself or setting yourself up to reduce your risk or eliminate your risk, so that way you're not being set back for trying to get ahead. And all those things are very practical, smart things to do in everyday life, and you'll actually learn that kind of stuff here. Yeah, I'll get those strategies made out on one of these videos, and then you can look through and you can see it in the title. I'm not really sure. I'm not really set up on my channel yet, but I'll probably divide things up in certain categories, and that way things are easier to sift through. Later on I'm going to start adding news and maybe entertainment, some kind of entertainment bits or something. But for sure the next level would be news at some point, so I'm just not to that level yet. I may add perhaps DJing. May DJ at the same time and see if that doesn't go anywhere. Could get a lot of hits for that, perhaps, and we'll see about that. But that would be pretty tough, DJing and trading at the same time, and then news afterwards. Yeah, who knows? We'll see though. Okay, well, good luck.